Ladies and gentlemen, welcome to the Startup CFO. Knowing that cash flow is the most important thing to watch for Startup CFO, the question might be, how do you do that? How do you develop a liquidity planning in general? There are two main aspects to a liquidity planning. They have a short-term aspect and they have a long-term aspect, and you have to do both as a startup CFO, but these are slightly different tasks. So what are the challenges short-term versus long-term? Short-term, first of all, it is to manage the operative business activities with the focus on what are the costs, so cost control on the one side and on the other side, sales control to some extent. Do the people pay their bills? And I'll go into that further on the next slide. And the long-term aspect is the main development of the startups and what are the drivers of this development within the next 1, 2, 3, 5 years, a little bit depending on the business. If you have an R&D intensive business in the med technology sector, you probably have to have a longer focus for your developments. If you're working in internet business, it might be a little shorter, but in general, you have to understand what is driving your cash flows in general and what are the consequences of the change of those drivers to your cash flow statements. Let's start with the short-term liquidity planning because this is how to prevent actually insolvency in the first place. If you can't pay your bills, you have to file for insolvency. So what are some of the ground rules for the short-term liquidity planning? Actually, what you will do is you will monitor sales on the one hand and costs on the other hand. But you don't do it, well, you do it in general, but what you can do if you want to monitor sales, you cluster your sales into relevant key account groups because different buyers have different ways of paying you and different ways of paying you early enough or prolonging the payments and so on. So this is the first thing you'd like to monitor, trying to understand who's paying early enough and who's paying later and who's not paying maybe, and trying to get an understanding of is there a way to manage that? And then you will compare budgets, so your actual and your budgeted sales performance, and you try to understand whether you might want to change customer groups, just from the financing perspective. And that's the first thing. So getting an understanding about sales. And the second thing, the same thing, is you cluster, you try to get an understanding of your cost structure. So what are my variable costs and what are my fixed costs? So what I have to pay each month and I can't really change it. And what are my variable costs and actually what are the cost drivers such as personnel? And is there a way to change those cost drivers if I run into some troubles? And this is a good way to understand also the entire business. And this is why you develop a weekly cash flow statement based on this. And with your cost clustering, you define a minimum level of liquidity for your business. And this is what we said before. If you open that bar, you have to have some liquidity because you have to pay out right now for certain, and you might get it back uncertain in the future. And you try to determine your cash burn after months in order to define expected cash out dates. So you try to get an understanding for your potential to grow with the working capital you have and so on. And so this is in general what you do in the liquidity planning. So you try to understand sales, that's the first thing. You try to understand cost structure, and then you put it into statements, which is those cash flow statements, which gives you, first of all, transparency on the core cost drivers, also actually on the core sales. You can identify committed capital, especially working capital, And by doing that, you obtain a level of, or a higher level ideally, of financial control and get an early warning if something is going in the wrong direction. And you can prevent insolvency because if you run out of liquidity, you run out of money. That's what you do short term. What you will do long term is slightly different, because long term you have to understand your business, which is the next 2 to 5 years on a higher level. You can't do it in such a detail like you do it with the short-term cash flow statement, with the cost drivers, and especially the customer groups, but on a higher level for a longer time. And in order to do that, you might want to understand the industry. So you do industry research on the potential when developing your budget. So what are others, startups, and other people's experience in that sector? What about the customer? For example, if you sell fashion in the internet, there's still in some countries a 50% return rate, which actually means for 50% of the products, you basically never get the money, or you at least don't get it on time, because people buy it, they return it, buy it, return it. So the 50%, you have to have working capital for that. Try to understand, by doing industry research, what's happening in specific industries and what does it mean for you, for your cash flow planning. In that case, 50% working capital. And if you understand that, and if you understand what could happen to you, you stay flexible and you have a chance to adapt your budgets if necessary. If capitalists change their mind, they call it paradigm shift, they don't give you money anymore, how can you be strategically flexible to adapt your cash flow structure in order to follow the new strategy? And how do you do that? In a little more detail, and don't want to go through all those bullet points over here, but in general what you do is you try to understand and then you try to do your projections in terms of cash flow. That's the main idea. So you define growth indicators for your business. You try to understand the assumptions for your cash flows, and you relate your investments to your assumptions, and you try to convert it into cash flows. You're trying to understand cash flows for operating investment activities, and by that building your monthly cash flow statement. In some business, you start on a weekly basis at first, and then you go over to monthly and yearly, really also depending on your business, how fine-grained you wanna or you have to do that. And it also helps investors, because for investors, the cash flow statements normally provide the most important information, since it also gives the investor a good feeling for, if I invest money into this company, it's not going to run into bankruptcy because they run out of money, they can't pay a bill. Because what could happen is, if your developments go well, you have great developments of your products, but you run out of cash. And you have to close down your company, although you're in the best scenario you ever imagined with your R&D. This is what you don't want to have, and this is actually also what investors don't want to have. So investors have to gain confidence in the startup CFO and actually into the work of the startup CFO. And they do it by looking at the cash flow statements and by understanding the cash flow statements of the startups. And this is why we have to spend so many thoughts into the cash flow statements. Actually, some of the investors, they want to have your Excel and they play around with the numbers and try to get a feeling by themselves, and then they start discussions with you on drivers and what could happen and all sorts of things. This is why building your own cash flow statement is very, very worthwhile as a startup CFO, because that gives you the deep understanding. There are programs for doing cash flow statements. I would never do that. I would always take an Excel sheet and try to build the entire sheet by yourself, really understanding your business, really understanding your drivers, what is the cash from the operating activities, well, resulting in cash from operating activities, from investing activities, and from financing activities. And just going into some detail where you can see that this is different to a profit and loss and balance sheet. If you look at that over here, you have the net income, depreciation, amortization. So net income is also without, so it's deducted depreciation, amortization. This is why in a cash flow statement you have to add it again because you have to have the income at the very end. And then you look at what do you need for cash in order to finance these activities, and what do you need as cash in order to invest into these activities. And if you have a machinery, you can buy that machinery and you have to pay $1 million, and nobody cares about depreciation. Even if you use that over 10 years, you have to have depreciation in your profit and loss statement, but in the cash flow statement, you have to pay for that right now. Or you can think about leasing models, which is more expensive maybe. On the other hand, you need less working capital. And that's the difference here. And this is why going deeper into those details is worth a lot for a startup CFO. Actually, this is basic business administration, trying to understand profit and loss statement, balance sheet, and the difference to cash flow statements. But you see, first of all, it's about what is the money going out of my pocket and what's the money going in my pocket. And don't think about those artificial things like depreciation or amortization. And if you do that, you end up having a good idea about the cash from operating, investing activities, and from financing activities in general. And if you have a good sheet on that, you can also play around there with some of the numbers, with the drivers. In most cases, what you, by the way, might want to do, or you probably should do, is put the drivers on the one Excel sheet and numbers onto the other Excel sheet, and try to connect the two Excel sheets in order to be able to play around with the drivers and look what happens at the very end, how the changes in the numbers are. And if you do that, and if you just play around with that, just take a night and play around with your Excel, you have a very good feeling on your own business. However, before, do some research on others who are working in the same industry, because this always helps you to understand sales cycle, development cycles, payment cycles, return rates, whatever is necessary to know for the cash flow statements.